Good morning. Welcome to Stock Market Today. It's Friday, September 11th, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider. And that hits your inbox every trading day before the market opens. So U.S. equities finished lower in Thursday's trading, ending near their worst levels. Major U.S. indices are on track for a second consecutive weekly loss. All sectors were lower, with energy and technology lagging the broader tape. Materials were a relative outperformer. Treasuries were stronger with the curve flattening. The dollar was mixed on the major crosses. Gold was up 50 basis points. WTI crude down 2%. Key news items yesterday: initial jobless claims came in weaker than expected, and the slimmed down fiscal stimulus bill was voted down in the Senate. So that increased some pressure on the market throughout the day. So we get to the desk this morning, a little bit of a rebound with S&P futures up about 90 basis points following a mixed session in Asia overnight. European markets are trading mixed as well. Treasuries are flat. The dollar is weaker against the euro, but stronger against the yen and sterling. Gold is down 60 basis points. WTI crude is down 30 basis points after coming under increased pressure this week. Once again, if you take a look at a crude chart, you can see it failing at resistance and beginning to roll over. So that's the framework as we enter the final day of the week. We'll take a look at the major market averages here with a focus on the S&P 500. S&P 500 still below key support at 3,400, but the Qs and IWM thus far are holding. Remember what we said: QQQ, the bulls want 270 to hold. IWM 150 is a key break point. We're kind of at those levels, but rebounding here this morning. So thus far, the averages remain bent, not broken. For the S&P, I like to use the S&P as a trigger and then drill down on the relative strength from there. 3,300 to 3,400 is in support. We are in the zone. 3,250 is the key level below that. Resistance now 3,500 to 3,600, in that range, with 3,600 being the local high reached last week. 3,500 just kind of being a round number, and also the middle of this extended bar to the downside. So that's the framework as we dive in to the final trading day of the week. I lay out a roadmap in my note to Chaikin clients today. The long and short of it is we're kind of stuck in this no man's land right now. Ideally, what you'd like to see if you're bullish is a quick retake of 3,400. That would be a signal to start to look to get more aggressive on the long side. However, if we continue to lower from here, you want to look for 3,250 to hold. And if that level shows signs of holding, then it makes sense to become aggressive on the long side at that level. In between, a lot of chances to get chopped up. A lot of cross currents in the market right now. So that's the framework and the roadmap that I have in the conversations that I'm having with myself. So wanted to lay that out for you here today. Let's take a look at our market in a minute now. Based on our indicator, our overbought, oversold indicator, SPY and Qs enter oversold position. So that's, kind of step one that we were looking for. After selling pressure resumed on the day yesterday, IWM remains in an oversold position. Senate fails to pass further stimulus and initial claims miss expectations. That was kind of the easy go-to for the pressure yesterday. Discretionary versus staples is actually a bullish data point, and now we're going to start to look for semis to reestablish a strong relative trend. So we connect the dots. These are other aspects of what we're looking at to give us confidence that support will hold, or if we break back above 3,400, that's likely to persist. And as we did say, futures point to a higher open here today. Taking a look at the power bars now for the major indices, deterioration, but still skewed in favor of the bulls is kind of the best way to frame this up. Dow lost 1.4% yesterday, 8-2 bulls to bears there. The S&P 500 down 1.7%, 131 to 89 bulls to bears there. Importantly, our Chaikin bullish percent indicator, which we highlighted earlier this week, crossed back below 30%. That can lead to further volatility over the next month of trading. So key data point that we pointed out earlier this week, the NASDAQ was your underperformer, down nearly 2%. 23 to 11 bulls to bears for the NASDAQ. Small caps are relative outperformers, 605 to 333 bulls to bears there. Flight to safety sends bonds higher, yields lower. And according to the Chaikin Power Bar, small cap stocks and large cap stocks are somewhat bullish. Major markets across the board are mixed. So that's where we stand as we enter the final trading day of the week. Let's hit our stock of the day now because, we are going to look for potential opportunities. And for me, I love these sell-offs, especially quick hit sell-offs, to number one, see where is the relative strength, what holds up the best, but also to see where is potentially new relative strength emerging, who held up, right? Who held up that maybe necessarily wasn't holding up earlier. And McDonald's hits my radar screen this morning. McDonald's recently saw its rating turn bullish back in early August. But at that time, the stock was still an underperformer. So we have a bullish rating. We have a strong trend above a rising long-term trend line. And the hotels, restaurant, and leisure group, at least based on the power bar ratio, is strong. So when I take a look at that, I say, okay, well, what's going on here? Is this a name that's starting to show some relative strength? And it is. Take a look at the relative strength versus the S&P 500 here, ticking to the upside. This is what we call personality change. Rating, look at the rating, has been persistently neutral or bearish for most of the past 12 months. And then August, the rating turns. But the rating is not enough. We want to see relative strength. Now we have relative strength pushing to the upside as well. That jumps out at me. That's really interesting. So we have McDonald's pushing up against 52-week highs. It's oversold based on our indicator. Chaikin money flow has been persistently bullish since early to mid-July. And now we have this personality change. So that's an interesting setup to me. On top of that, one of our buy signals triggered a relative strength breakout signal, triggering, which makes sense as we have new relative strength here in McDonald's. So I think if you are looking for names, this is an interesting name to take a look at. Especially if we can get some momentum to the upside, right? It's not so much, looking for the Facebooks, Amazons, and Googles of the world that have gotten hit, right? You can do that, but there are other opportunities out there, and these pullbacks in the market set up the potential for new leadership to emerge. Is it guaranteed? Absolutely not. But is it a higher probability than it was just a week ago? Absolutely. And that looks really compelling to me. Take a look at McDonald's if you're looking for ideas. Notice it was up 71 basis points in a down tape yesterday. So there's the relative strength on a one-day basis. But here it is playing out on a longer term time frame as well. Take a look at McDonald's as a potentially bullish idea today. Turning into our sector tracker now, the movement of the major sectors over the last 5 days, a lot of red on the screen. So it becomes a relative game, if you will. Interestingly, the top two sectors are the two cyclical sectors that I like the most, materials and industrials. They're holding up the best in a down tape. After that, it's your defensive groups, utilities, and real estate. That rounds out your top four. Middle of the road here, discretionary staples, healthcare, and the fins. Comms and tech have borne the brunt of the selling pressure over the past week, maybe working off some of those extended positions. I talk about growth over value. I look at the fan mag names in my note today. And what I would say is, again, kind of bent, not broken in those relative relationships, working off extended positions. I mean, 2 weeks ago, we highlighted the fact that growth over value was about 20% above its 200-day moving average. And we said, hey, we're not going to chase this here. Don't chase the strength in these names, right? We highlighted a bunch of reasons why in our notes and in various other media platforms, right? So what do we have here? I think it's still calling it bent, not broken for those themes. We'll see if it morphs into something else. Energy, on the other hand, is broken, right? And it's been broken for a while. We've wanted to stay away from it. That's largely been the right call. The group's been an underperformer, and over the past week of trading, it is down 7%. One of the groups that we do like, though, is mining services, our industry in focus today. We've talked a lot about materials. We've talked a lot about an inflation-type trade out there. So you take a look at a group like mining services, XME, the ticker symbol for the ETF, has outperformed the S&P by 18.75%. Power bar ratio 7-0, bulls to bears, number one of 21 subsectors, having moved up 4 slots. So if you're looking for bullish ideas in a thematic sense, right, this rising inflation type environment, you can take a look at names like Alcoa, AA, very bullish, Reliance Steel, RS, very bullish, and Schnitzer Steel, SCHN, with a very bullish Chaikin power gauge rating for a group that, in fairness, the ETF has a neutral rating, but the trend is strong above our rising trend line. Notice the outperformance. All right, working towards an oversold condition, predominantly bullish money flow since the June timeframe. So we have nice turn here, breakout, and now we're pulling back to test that breakout level. So ideally what we want to see is XME hold right here, kind of snap back above 24, hold that level. And then it becomes interesting to go drilling down on the holdings. There are 7 bullish stocks in there that you could potentially look at. I just showed you 3 of them on the previous slide. You can start to take a look and drill down on those names. Let's dive into what's trending now. Yesterday's S&P 500 movers and shakers. Tapestry caught a positive initiation yesterday, up 8.37%. No news on Newell. NWL, very bullish stock, up 4 3/4. TSN, one of their competitors caught an upgrade at Goldman Sachs, so TSN goes along for the ride. And then the bottom 2 are related. Quest, DGX, up 3.2%, raised their fiscal year 2020 guidance, and LabCorp, LH, goes along for the ride. Both of those stocks up over 3% on the day. Loser side of the board has something in common. It should quickly jump out at you. Energy. The data point yesterday was the DOE inventory data, which weighed on crude oil and therefore a lot of the energy names. Now, EOG also had some news out of Colorado as it relates to setbacks, which was also a negative for that stock, down 9%. But the rest didn't see anything company specific, largely a function in my mind of weak energy stocks in general stemming from that DOE data and oil coming under pressure this week. So APA, Oxy, Devon, and Hess all down over 7% on the day. Let's dive into the charts. Discretionary versus staples, and we look at this on an equally weighted basis to account for Amazon's weight in discretionary, roughly 25% of that group. And what's interesting to me is as the markets come under pressure, this ratio has not cracked. Okay, so that's a positive data point. That tells me that this could be short-lived, right? It's one of the data points that we want to see, especially when we look at the next 2 data points, if they start to improve. But you can see here, after being under pressure for the better part of 2 years and then really capitulating into the COVID bottom, this ratio has marched higher. RSI has shifted into bullish ranges, and we're now testing the underside of broken support. But again, I do find it interesting that this has not cracked, right? The market's rolled over, discretionary risk on, staples risk off. Look at them equal weight to account for Amazon, and you would expect this to be cracking given the weakness in the market, and it's just not. So that's kind of interesting to me, something to keep an eye on, take a look at. We can dive into some of the maybe idiosyncratic data points as it relates to things like home builders and some of the retailers that are perking up on the discretionary side. But I do find this fascinating. Now we're at a key level above the 200-day, but below broken support, which we are now testing from below. Semis on a relative basis is the one that bothers me. It's bothered me for the past couple of weeks. It was a big part of my view that you should not be chasing strength in the market. And I've been writing about that in my notes to clients. I've been saying, make sure your risk management process is in place, strict, and followed. Take a look at SMH relative to SPY. Still an uptrend. All right, let's get that out of the way first. Still an uptrend from a longer term perspective above a rising 200-day moving average. But it's the near term that is bothering me because it's been under pressure. We do have in the near term, since the beginning of August, a series of lower lows and lower highs. Also, same dynamic at play for the RSI, which, as we'll notice, did not confirm the high. We talked about this last week, right? Lower high for the RSI as the ratio was making a higher high. That was a big part of our heads up. On an absolute basis, you can see the trend still up and to the right, bent, not broken. I'll beat that horse for now. When it breaks, we'll say it's broken. But for now, that does remain the case. If you're bullish and you want to build on the discretionary staples data point, you want to see this relative ratio snap back and snap back soon. That would be a key tell again, right? So if you think of the framework that I laid out, either hold support at 3250 or break above 3400 for the S&P 500, continue to see discretionary outperforming staples, watch this snap back, and ideally you'd love to see this ratio get through the 200-day moving average. This is high yield relative to treasuries. Think of it as a proxy for risk on, risk off. Below the 200-day moving average, below broken support, but RSI potentially shifting to a bullish regime. Now this is playing out as treasury yields are kind of bouncing along the bottom there, turning lower this week in a flight to safety to treasuries. So key inflection point for high yield relative to treasuries, one of the key data points that we'll be watching here in the days and weeks ahead. That's going to wrap us up for today, folks. A thank you all for taking time out of your day to spend it with me. I hope you have a great weekend. Take us for a test drive. I'll be back on Monday.